Welcome to the Win and Wealth Podcast. Today, we are going to be talking about the real estate investment that we are most bullish on in 2024 and the years to follow beyond that. We're going to really dive into breaking down why, from a macro perspective and micro perspective, we love this asset class, getting into the weeds here. So listen to the whole episode. We hope this provides a ton of value and maybe you get some inspiration to also get involved in this asset class.
That's me in a nutshell. Maybe we do that after. I don't think we're that close.
But real quick, before we get started, I'm going to say there's two things you need to do to become a millionaire. Number one, you need to take these. Now look at the video. It's Kratos Performance. Jeff and I take these. This is the inspiration behind a lot of the gold we spit here on the podcast. And number two is you got to go over to YouTube and click that subscribe button, Winning Wealth Podcast. You do those two things and you're well on your way. All jokes aside, all right, we're getting into today's episode where we're going to do a deep dive on the asset class that we're going all in on this year. We've been working on this new thing for 6 months now that's really doubling down in this asset class. Before we get into that, I just kind of wanted to give a little bit of brief background again on kind of what we've done and has led us to being so bullish on this asset class. So our company, Smart Asset Capital, started back in 2019, and we've been involved in most real estate asset classes. So we started in multifamily, did some office, we did some retail, we did self-storage, we did industrial, we did mixed use. We've been involved in most of the asset classes. And throughout that time, over the past 1.5, 2 years, we've pivoted into the industrial space. So buying warehouses in Wisconsin, that's been the space that we really decided to niche down on and where we're going specifically all in this year. So this year we're raising $20 million. We're going to go out and buy $70 million plus of this industrial specific deal type we're about to talk through today. So to preface that, I'd like to get into starting with the case for industrial real estate as a whole, why we love that asset class so much. Jeff, you want to kick that one off?
Yeah, what we're going to do is we're going to start sort of macro and then niche down into like sort of exactly what we're looking for. And so, from a to start off, the case for industrial real estate, if you look back over the last 20 years. And I know, the thing is, a lot of people could say, well, shit, COVID happened and everything's different. There's a lot of differences over the last, from 2020, 2020 to 2000 than what's going on now. But if you look at the last 20 years in total returns and in rent growth and in occupancy rates, the industrial asset class pretty much beats office, retail, and multifamily in each of those categories: total returns, rent growth per year, and occupancy rates year over year. So that's one thing, to look back historically in America. This is the United States, of course. So from a very macro level, it's a very stable asset class. And then if you look at, there's a lot of reasons, even during COVID, with the supply chain disruptions, the advancements in technology that are changing the way businesses think about their supply chains, robotics, and all of that. Going forward, we're still very bullish on it. So, just to talk through.
And I would highlight too with that if you look at from a data set, the total returns, rent growth, and occupancy rates, if you look at those three buckets in the asset classes of industrial, office, retail, and apartments, so really the four biggest asset classes within real estate, industrial has led out of those four asset classes in all three categories. So it's a very strong, it only was accelerated through COVID, obviously with some of the things we're going to talk through today being the driving factors, but it's historically been a strong asset class and continues to be as you look at where we're at today and forward-looking data where we're going. Industrial and apartments really tend to be the darlings of real estate, they call it, right? I mean, obviously everyone knows the case for office is down in the dumps and not really a bright future painted so far for office. But those are really the two strongest asset classes historically and forward-looking. And industrial, even in most data sets, beats apartments.
Yeah, you're not wrong, right? And the case for multifamily remains strong. I have no doubt. I'm bullish on it. We own some apartment buildings. There's not enough roofs to be over everybody's head, right? We are becoming more of a renter nation, so totally get multifamily. I also like neighborhood strip malls as well. We own one. We love it. It's a great asset that we have. But if you look at industrial, you start to look at the underlying sort of headwinds that or tailwinds, I should say, tailwinds pushing this asset class forward. First and foremost, as nobody would disagree with, there's an e-commerce boom that's been happening, and it's only continuing to grow. So in the U.S. alone, online spending surged to over 1.1 trillion in 2023, which was a 7.6% increase from 2022, and there's really no signs of it slowing down. So, e-commerce, you think about it, these businesses, they need places to make the stuff, they need places to store the stuff, they need places to be able they need to get closer and closer to their end customer. And so there's a lot of reasons why e-commerce translates into more demand for industrial space.
And I think with that too, a lot of people might just think, okay, well, e-commerce, that just means the big Amazon warehouses, and that's what drives industrial demand for e-commerce. But like you said, I mean, think about the pallet that gets shipped on, when the product arrives at Amazon, right? It's on a pallet. That pallet needs to be made somewhere and stored somewhere, right? It's one of our tenants actually is a pallet refurbisher. The plastic that wraps around the pallets, right? That needs to come from somewhere. There's so many more pieces in the process than just the end product landing in an Amazon warehouse and then going to your doorstep, right? So that's where a lot of stuff we do, right? We don't own Amazon facilities or Amazon buildings, right? We're more so, our tenants are a lot of the products that take place within that process.
Exactly. And that's only going to continue to grow, from what we can tell. Another point is just high-tech manufacturing on the rise. So there's future-focused manufacturing initiatives such as clean tech, electric vehicles, and just advanced robotics that'll drive demand for industrial space. As robots, think of like a Roomba, cleaning your floors, right? Single-use robotics. Those are just getting smarter and smarter and better and better. I had a Roomba. I don't have one anymore, but I did, and it would annoy me a lot. But as those get smarter and more useful, right? And then there's industrial and commercial uses for these robots. That just makes the ability to make the warehouse more and more efficient, right? And as those innovations happen, it also translates to more demand for warehouse space. It also translates to the more efficient these companies can be with advanced robotics and high tech manufacturing. That translates to the landlord's bottom line in the end of it. So that innovation, that's not going to stop. It's only going to continue with the Internet of Things and artificial intelligence and advanced robotics. That sort of gets passed on. That innovation sort of gets passed on to the people that own those buildings. So that's another big reason that we're very bullish on industrial, and warehouses. Another one is the reshoring movement, sort of made in America. They call it onshoring, reshoring, nearshoring. Nearshoring would be sort of like Mexico. But throughout COVID, what happened was supply chains got majorly disrupted. And if you had your product was all the way across the Pacific Ocean or in Asia Pacific or whatever, right? Like you saw some major disruptions, and so a lot of companies are starting to bring their manufacturing back to the United States and their supply chain back to the United States or closer to the United States so that they can be, as I mentioned before, you want to be as close to the end customer as possible. Someday Amazon wants you to be able to buy now one click, and they want to be able to zip a drone over and just drop it in your yard. Forget this same day. It's like, hey, same hour or 10 minutes, you can have this thing, right? And that is, it sounds crazy, but that's sort of the future of where things are going. They passed the CHIPS and Science Act in August of 2022, and that has really incentivized companies to reshore their manufacturing facilities and operations back to the United States. We're seeing that locally, but that's only going to sort of continue as companies got smart and realized once they offshore and outsourced all of their operations way across seas to get, sort of cheaper labor. They realize that that's not a good thing if there's a major disruption in their supply chain, and they're getting a lot of revenue leakage out of that by some sort of huge disruption that happens, such as COVID, right?
Yeah, I think that's a huge piece that's going to drive this from a economic standpoint, right? And that's just going to drive more demand for these warehouse spaces. And then the fourth point within again, looking at kind of the macro industrial space of why we like it, long-term triple net leases. So the first piece of that long-term. Generally in industrial, you're going to see, 3, 5, 7, 10, 15, 20-year long leases, right? So they're very long-term leases compared to, right, if we're comparing it to multifamily, it's generally a year-long lease, right? So there's going to be more turnover. That being said, there is, that does come with the downside of it's not as easy to lease up, right? So there's certainly things there. We won't go too into the weeds on that. That might be a different episode, but long-term leases. Second part of that, triple net leases specifically. So what the triple net means is the tenant pays for all of the operational costs of the building, right? So the tenant's going to be paying for property taxes, insurance, snow removal, if the toilet breaks, right? They're taking care of the building. The only thing the landlord's responsible for is structural. So if the roof breaks or you got to replace the parking lot, that's going to fall on the landlord. But really these buildings, right, long-term triple net leases, you find a tenant for a 5, 7, 10-year lease, it's pretty turnkey from that point, right? You got your rent set. You're already going to know what your numbers are. It's predictable cash flow. You're going to forecast out the roof needs to be replaced 5 years from now. You can prepare for that. So it's very much more so a predictable cash flow business compared to, again, comparing it to multifamily, where it can be a little bit more year by year. Things are changing. Tenants are moving out. Again, we like multifamily as well, just kind of highlighting some of the differences on why we personally prefer this asset class.
Yeah, and I would say, just to caveat on that, right, multifamily and self-storage particularly, they have built-in diversification. And so why we're launching a fund is we want to be able to look at a portfolio of properties together and build in some of that diversification, and then also have the long-term leases and the predictable cash flow. That's the number one thing that we're looking for. The three things that we're looking for are predictable cash flow, downside protection. We want to mitigate risk and ensure that we're not going to lose any of the capital, and then lastly, we want some upside potential. And you can do that with taking gross leases to triple net leases and extending the length of these leases. And so that's a huge benefit for industrial properties.
Yep. And then going into the next stage. So we talked about the kind of, again, macro industrial, and now we're going to get a little bit more into the niche that we define that we're, again, so bullish on. So the first piece of that is Class B industrial. So we're going to talk through a few points here on why we prefer Class B. And again, just to highlight, and oftentimes you hear there's Class A, Class B, Class C, right? And that can apply to location. It can apply to the quality of the building. In this scenario, we're implying both, right? Location-wise, also with the age of the building is an often indicator of a Class A, B, C. So generally a Class B means built before the 1970s, right? It's a little bit older of a warehouse. It's not the shiny, brand new big box you see when you're driving down the interstate. So we're going to go through a few of those things. So within the Class B industrial space, one of the things we love is a sticky tenant base. So what that means is the tenants you're going to see in a Class B space, right? You're going to see light manufacturing, general warehousing, 3PL, right? These sort of tenants that are very sticky. And what that means is when a tenant is growing in a Class B space, right? Oftentimes, again, I'm going back to apartments a lot, but a lot of times in apartments, if someone's renting a Class B apartment, right? So workforce housing, paying $1,000 a month, very basic apartment, a decent location. They get a big raise at work, a big promotion. Now they're going to go move to Class A, right? They got the cash now. They can afford the extra $500 a month. They're going to go move into that Class A shiny apartment. Within industrial, a tenant that's in the Class B space and running their business, if their business grows, 50% over the next couple of years, they stay in that Class B space, right? Because they don't have a need to go to Class A and have the shiny office and all those things, right? They might take more space, right? Their business might grow and now we need another 50,000 square feet. So they might move to a different building. But these tend to generally stick within that same Class B space. Again, going back to it's a very sticky tenant base.
Yeah, no, I love that. And that's a real thing. I mean, and obviously sometimes, this is generalities, right? This isn't always but typically we see them staying within Class B. The next point is last mile locations. So as we were talking about before with e-commerce, Class B buildings are typically situated in these well-established areas. One of the drawbacks is that they're vintage and they've been built in the 70s, 80s, whatever, right? So they're not Class A that's being built in recent times or being built right now along the interstate. They might be sort of close proximity to residential areas and sort of essential infrastructure such as highways and rail, which is crucial for being close to the end consumer. As I mentioned, I think that's the third time I already brought that up, but the closer you can be to the end customer to get product to them quicker, the better it is.
And just to highlight that, I mean, from a, just picture view, right, is these buildings, again, have, generally, 1970s and in that size, in that range, right, they were built at that time, right? So these buildings are already there. So you can't necessarily replace those buildings. A lot of the Class A big box, no matter where you live, you're driving down the interstate, you've seen these, right? The 200,000 square foot plus warehouses that are going up off the interstate, right? You generally see them more like they're in a field, right? It's not necessarily surrounded by residential homes, like Jeff was saying, kind of have that infrastructure built in. So it's another reason we like this, is just it provides that good location that tenants want.
And also to elaborate a little bit further on that, those are typically, because of the locations, sometimes they're looked at as redevelopment plays, but it's harder to find space in their land in there to build a brand new Class A facility in those locations, right? So location. If we can find a Class B building that maybe doesn't have as high as ceiling heights or clear heights, or it doesn't have all the bells and whistles, or it's shaped a little bit funnier, but it's in a great location, we'll take that all day.
Absolutely. And then the next piece is irreplaceable asset class. We touched on this a little bit, but just to highlight. So if you look at like a lot of the product we're buying, right, is $50 a square foot, around that range. The cost to build, and again, this can vary, but the cost to build a new warehouse right now is at least $150 a square foot. So 3x the cost of what you can buy this existing asset at. So that being said, of course, if you're going to build $150 square foot building compared to $50 square foot building, that means the rent's going to have to be 2 to 3x higher, right, to be able to hit the return you would need as an investor. So that goes right back to the tenant. A lot of times why these tenants stay in the space, right, is they're getting a much cheaper rent. They don't need that shiny Class A office space, right? Their business is doing fine in this Class B space, and they get a much cheaper rent. So it's another, selling point for this specific niche within industrial is you just can't build this stuff at the cost that you can buy it at.
Totally agree. And that's one thing that we loved. Lastly, within Class B, as opposed to Class A, there's just more value add potential. There's typically more meat on the bone, more value add levers that we can do for value creation. And so, the Class B space typically provides better cash yields to the investor as we're acquiring at a lower basis from a price per square foot perspective.
Value add, baby. That's how you make the big bucks.
That's right.
All right, so then we're going to go into the third point of really niching down, and this kind of completes the circle of the niche that we're targeting. So 20,000 to 150,000 square foot industrial buildings in tier 2 markets. So let's kind of break that down.
Stay with us here. Stay with us here.
We're getting a little in the weeds, but this really shows.
Yeah, we'll link to some of the graphs that we have in the notes or whatever, right, to make sure, because the visualization will help look through this a little bit more. But go for it, Brock.
So the first piece, 20,000 to 150,000 square feet, right? So that's obviously the size of the building, and we're going to talk through a little bit more of why we like that size range. But the second part, tier 2 markets. Let me just briefly highlight what the difference between a tier 1 market and a tier 2 market is. So a tier 1 market is going to be a market with major economically robust center with extensive development and higher real estate demand, right? So you could think of like Atlanta or Tampa, Florida, or Austin, Texas, right? These are tier 1 markets that are booming, right? A lot of people are moving there. A lot of jobs are going there. These are very big name markets within the country. A tier 2 market is one that is growing or emerging with moderate economic activity and investment potential. So what does that mean, right? That a tier 2 market would be like a Milwaukee, Wisconsin, for example, right? It's not necessarily going to be at the top of the list when you look at places people are moving to, but it has that steady growth that ultimately makes it a tier 2 market.
Yeah. And so going a step further there, if you look at the total inventory of industrial space, that inventory is greatly changing due to the building of more large industrial spaces. So most of the development in both tier 1 and tier 2 cities, over 80% in each, is focused on the size bucket of over 150 to 250 square feet, and then secondly over 250 to 500,000 square feet. These are they're building the big stuff, right? They're building them for Amazon. They're building them for these large, massive corporations. And so really there's only been in the tier 2 markets, and even in tier 1, we'll say tier 1 and tier 2 markets, there's only been 6 to 9% growth in that 20 to 150,000 square foot size range. And so what does that do? That pushes up rental rates for the tenants that are in that space, because there's just not as much of it anymore to go around, right? Everybody's focusing on the big stuff, and thus rental rates for the smaller stuff, businesses that don't have a need for 300,000 square feet, they might have a need for 50,000 square feet. Well, where are they going to go? They're not building more. They're typically not building more of it. So, we'll come in and buy an existing asset and make it nicer, add some value, figure out what we can do to make it more efficient, and then hopefully be able to turn it around and rent it up at a higher rental rate than what it would have gotten previously to that.
Yeah, I mean, like you said, they're not building these smaller warehouse sprays, right? 20K to 150K size bucket. They're not building those, right? Because it just doesn't make sense from a construction standpoint, and that's why they're not building them. Is because in order to get the $150 price per square foot to build these things, you got to build a big box, right? To build these smaller ones, their cost would probably be up closer to $200 a square foot, right? And the economics just wouldn't make sense. So you can't really, in rare cases, people are building them, but it's much more common. Like I said, you're driving down the interstate, when you see new warehouses going up, they're that big box, right? 250K plus square feet. So that's really, like you were saying, I mean, there's always going to be tenant demand. Not every tenant needs a 250,000 square foot warehouse, right? A lot of tenants need a smaller warehouse, right? And maybe they grow into that one day, but there's always going to be demand. And if they're not built, there's always going to be strong tenant demand in that space. And if they're not building it, you do the math, right? It creates more and more demand for that space.
Yeah, you're totally right. The next thing is just vacancy performance. Even looking back to 2005, the vacancy in tier 2 markets, and specifically in that 20,000 to 150,000 square foot size range, the vacancy has outperformed, and it's shown the lowest level of volatility since 2005, and it seems to only be getting better going into 2023. I think our data's up through the first half of 23.
Yeah, and rental rates. I mean, yeah, it pushes rental rates, right? Yep. I mean, what that does is when there's so much demand, if there's only one, let's use an example, right? There's 150,000 square foot available in this market, and there's 10 tenants that need it, right? They all want this space, and you're asking $4 a foot for that space in rents. There's 10 tenants that want it, right? We're bumping that up to $450, right? So that it's just when supply and demand, right? The most basic fundamental of economics. And that's really how this is highlighted, is there's low supply and there's high demand for this sort of space, which creates a great investment vehicle.
Yeah. Lastly, this deal size is generally, and this has been core to our business since we started Smart Asset Capital, we're looking for deals that are too small for the institutional buyer, but essentially a little bit too big for an individual buyer, right? Like to go out and buy this type of real estate as an individual, even if you have the money, a bank is generally going to want you to have experience managing real estate. So that kind of cuts out a lot of people as well. But it's the deal sizes are typically too big for someone that's, a doctor to go out and just go buy this building by himself. And assume, sort of all that risk on his own. And it's too small for the institutional investor. So the play here is to build a portfolio of these, get them operating, great, add a lot of value, show predictable, stable returns, predictable cash flow over a long period of time, package them up and maybe sell it to an institution. And that's one of the plays that we're working on here at Smart Asset Capital.
And just to highlight too, the dollars, right? So our buy box is $2 million to $10 million deals. And like Jeff said, I mean, a lot of individual buyers, even if you get leverage, right, that means you need to put $500,000, $600,000 down in cash. People do have, individual buyers do have that sort of cash, right? But like Jeff said, a lot of times they lack the experience, right, to operate or find that sort of deal. Second, the bank might not finance them because they don't have the experience in real estate. And on the other end of it, right, the institutional buyer, that means, that the massive companies out there that have all the cash in the world, they don't even want to play in the, in that size range, right? Because it's just too small. They're looking for the, 10 million plus deals because that's where it makes sense for them to place their capital.
Yeah. And say I'm a doctor that has $1 million cash and I want to go buy a property. And I'm like, you know what? I don't want to invest it into a fund. I don't want to deal with any fees or anything. I just want to go buy it on my own and figure it out. First of all, the bank's going to be a little bit leery to just lend money to someone that hasn't bought real estate before. Second of all, you're going to be thinking a lot more along the lines of capital preservation and risk, and you're not going to be willing to buy something that might have 1 or 2 or 3 tenants when you could go buy an apartment building. You might overpay for it, but you buy an apartment building, it's got 100 units, and so you've got that sort of dynamic at play as well. Whereas if we have a fund and we've got $20 million, we can afford to take on the risk for a certain property that might go vacant, and we might have to hold that for a year or so while we're looking to lease that up. And that's core to sort of our business plan with this fund, right? We're looking for deals that are stable, steady, cash flowing deals with long-term leases. And then we're looking for also deals that have a lower WALT, weighted average lease term, so that we can essentially either get a new lease in place with the tenant that and move that up to market rent, or to find a new tenant that we can then move that, add some value to the property, turn it around and lease it out at market rent.
Man, I'm excited just going through this and get me even more excited. We've been working on this for a long time, and we'll have some very exciting news here to share. Maybe when this podcast drops, we'll be dropping some more news on how people can get in touch with us and get involved in this new opportunity we're working with, because we'll be opening it up to other people being able to partner with us. So hope you got some value out of this episode. Again, hit the subscribe button.
Smash the subscribe button and the like button.
We got some awesome guests coming up. Hit it up. Thanks for listening to the episode. So we talked about the case for why we are so bullish on 20,000 to 150,000 square foot industrial Class B and Tier 2 markets. We went step by step explaining it. I hope this provided some value to you. Again, I've said this a few times now. We're putting a lot of time and effort into growing this podcast. And one of the metrics we love to track is subscribers on YouTube. So please, if you're not on YouTube now or you're on there right now, take it 2 seconds, click that button. It'd mean the world to us. And also, we'll be dropping some more news on how you can get involved with us on this investment vehicle that we just discussed. So stay tuned to our website, smartassetcapital.com. You can sign up on there. I'm sure you'll see it in other places as well. But we'd love to talk more about how you can get involved with us. So again, hope you found some value, and see you on the next episode.